So, you want to be a millionaire? To do that, we need a reliable way to grow your wealth over the coming years. Two tried and true concepts for reliable wealth growth are compounding interest and dollar cost averaging. Lucky for you, we will be taking a deep dive into both today. Hi, and welcome to Finance for Fun. In finance, compounding refers to the process of generating earnings on an asset's reinvested earnings. This means that an asset's earnings are added to the asset's principal, and then the increased amount is used to generate additional earnings in the future. This process of earning on top of earning is known as compounding. For example, let's say that you invest €1 in a savings account that pays a magic annual interest rate of 100%. At the end of the first year, your investment will have earned €1, or 100% of the principal, in interest. If you leave the interest in the account and do not withdraw it, then your investment will now be worth €2, €1 principal plus €1 interest. In the second year, your investment will earn 100% on the new principal amount of €2, resulting in an additional €2 in interest. This means that after 2 years, your investment will now be worth €4, €1 principal plus €3 total interest. We can continue that in year 4. Our investment is now worth €8, then 16, then 32, and finally, in year 7, €64. Note that most of this is interest that you basically had to do nothing for, but wait. As you can see, compounding allows your investment to grow exponentially over time. This is because each time your investment earns interest, the interest is added to the principal, which means that the next time your investment earns interest, it will earn interest on a larger amount. This contrasts with simple interest, where the interest earned is withdrawn and is not added to the principal, and therefore the investment does not grow at the same rate. Start applying the theory of compounding interest today and watch your wealth grow exponentially. It is important to know that the power of compounding is greatest when it is applied over a long period of time. This is because the longer an investment has to compound, the more time it has to generate additional earnings on top of earnings. Starting early with investing will maximize your wealth growth over time. In summary, compounding is the process of generating earnings on top of an asset's reinvested earnings, which can result in exponential growth. It can occur on many different types of investments, including savings accounts, certificates of deposit, money market accounts, and investment accounts. Finally, the earlier you start with investing, the longer your investments can compound, and the larger and faster your wealth will grow. Many people compare compounding interest with growing grass. Both involve patience and discipline. Just as a lawn won't grow overnight, your investments won't make you rich overnight. Both require you to be patient and to stick to a plan in order to see the best results. So, you must now be wondering, should I run to an exchange as fast as I humanly can and dump all my money into the first stock I can get my hands on to maximize my compounding? Well, not really. This sounds like a great idea in theory, but markets are volatile. While over long periods of time prices generally tend to go up, the same asset may cost a very different amount of money today and tomorrow. So, how do we avoid accidentally spending all our money at a moment where assets are too expensive, hurting our returns in the long run? Luckily for you, you are not the first person to ask this question, and we have a solution for you. Dollar cost averaging is an investment strategy in which an investor divides their investment capital into equal amounts and invests these fixed amounts at regular intervals, regardless of the price of the investment. This means that the investor buys more units of the investment when the price is low and fewer units when the price is high. The main advantage of dollar cost averaging is that it helps investors to reduce their overall average cost per unit of the investment. This is because when the price of the investment is low, the investor can buy more units of the investment with the same amount of money. As a result, when the price of the investment eventually increases, the investor will have a lower average cost per unit and will therefore realize a higher potential profit. Another advantage of dollar cost averaging is that it helps to protect investors against the potential risk of trying to time the market. Timing the market involves trying to predict when prices will rise and fall and making investment decisions based on those predictions. However, this can be difficult. An investor who tries to time the market can end up buying at high prices and selling at low prices, which can result in financial losses. With dollar cost averaging, investors do not need to try to predict market movements and instead invest consistently at regular intervals, which can help to reduce the potential risk of market timing. Okay, blah blah blah, I have now talked a lot, but let's look at an example with some numbers. Imagine we buy €1,000 worth of assets and then sell them at a later date. In our lump sum scenario, we spend all our money at once and later sell when the price has gone up, profiting us a nice €1,500. In our dollar cost average scenario, we buy at 3 different moments. Each time we spend around a third of our €1,000 to purchase however many assets that gets us. As you can see, we ended up paying more for our assets than in our lump sum scenario for 2 of 3 transactions. However, because we spend a fixed amount of money every time, this leads to us buying more of the asset when the prices are lowest. We end up with 11 assets in total, leaving us with a healthy profit of €1,750, more than our lump sum scenario. We have successfully used dollar cost averaging to make market volatility play in our favor and improve our financial results. In summary, dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. This strategy can help investors to reduce their overall average cost per unit and protect against the risks of trying to time the market. Oh, and of course, you can do this with any currency, not just dollars. In our example, we used euros, but really any currency works. It's not called dollar cost averaging because it's only applicable to dollars. Maybe it's time to rename the term to currency cost averaging? We have now learned about dollar cost averaging and compounding. Together, dollar cost averaging and compounding can be considered safe and sustainable ways to create wealth. Dollar cost averaging helps to reduce the risk of trying to time the market and volatility by allowing investors to invest consistently at regular intervals without trying to predict market movements. This can help to reduce the potential risks of financial losses and smooth out the impact of volatility on an investor's portfolio. Compounding, on the other hand, allows investments to grow exponentially over time, resulting in much higher returns than simple interest. By combining these two strategies, you can build a road towards wealth in a safe and sustainable manner. Some people call this reality of investing boring. Of course, if you want a more exciting way to grow your wealth, you can always put your life savings on red in a casino. As always, thank you for watching our video. We hope that you have found this information useful and informative, and if you did, consider liking the video and/or subscribing. This has been Finance for Fun. See you next time.